Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of our InvesTips podcast. Today we're diving into a topic that's particularly close to my heart, impact investing. Now, impact investing isn't just a trend, it's a fundamental shift in how we approach long-term investing, an approach that focuses on resilience and responsibility. Joining me today is Eugenia Koh, the Global Head of Sustainable Investing at Standard Chartered, and unsurprisingly, she's just as passionate about this subject as I am. Welcome, Eugenia.
Thank you, Steve. I'm thrilled to be here today and to be able to share my thoughts, especially considering the global economy.
Okay, so I guess we should start with a quick definition. Impact investing is an investment approach that blurs the lines between philanthropy and financial markets, a strategy that allows you to pursue both economic returns and societal good. What do you think are some of the core characteristics that set these investments apart from conventional ones?
So when I think about impact investing, a few fundamental points come to mind. First, when you invest for impact, you're driven by a clear purpose. You actively seek to generate positive social or environmental outcomes through these investments. So impact is deliberate. In your conventional options, impact may be incidental. Second, when you think about impact investments as opposed to philanthropy, these investments can offer you a vast spectrum of financial returns, just like your conventional asset classes, such as cash equivalents, fixed income, venture capital, and private equity, but their impact varies. All of these options offer specific risk-return dynamics. So basically, unlike pure philanthropy, where you aren't seeking financial returns, impact investments are structured to generate returns aligned to your goals.
So let's talk a little bit more about returns, right? That's obviously a key concern that often comes up. Many investors assume that seeking sustainability outcomes in investments would inevitably lead to lower financial returns. What's your take on this?
Yeah, that's a great question, Steve, and one that I often get. Let's tackle it with some facts. We have data from the Global Impact Investing Network that says that impact-related investments in real assets have exceeded projections by 2%, and likewise, investments in public equity have exceeded estimates by 1%. Also, the Cambridge Associates Impact Investing Benchmark shows that high-risk impact funds have outperformed traditional benchmarks. These are just two instances that demonstrate how impact-driven investments can indeed be competitive from a pure returns perspective. Like traditional investing, however, impact investments do have a range of financial returns. So while some impact investments may deliver lower financial returns, others do offer comparable or better returns. But what's more important, Steve, is that investors realize that integrating impact priorities actually enhances important aspects like market insight, risk management, and of course, long-term resilience. When your capital is aligned with your purpose, you gain deeper industry knowledge, you anticipate risk better, and position yourself for long-term success.
Okay, so you talked about integrating impact priorities and return objectives. Obviously, there are different types of investors out there. What would you say are some of the ways in which each segment of investors can integrate financial performance with impactful social and economic outcomes?
There are a wide range of opportunities for investors to align their financial objectives with meaningful social and environmental outcomes. This includes impact investing, but there are also other approaches such as ESG investing, which is the incorporation of environmental and social outcomes into the investment process. The focus for ESG investing is better risk management and capitalizing on long-term opportunities. So let's start with some of the biggest players. For financial institutions such as banks, pension funds, financial advisors, and wealth managers, we could look at a range of investment options that support environmental and social development. This would be avenues like renewable energy, affordable housing, and accessible healthcare. These options offer substantial potential to unlock growth. Many of these institutions are also acknowledging that ESG risks can impact the long-term performance of their portfolios. Another category of investors would be institutional investors and family foundations. They can take lessons from entities like Bill and Melinda Gates Foundation, which demonstrate how assets can be leveraged to advance core values while maintaining and growing their endowments. Government and development organizations have also committed significant resources to impact investing, and there are more and more opportunities for the private sector to partner with them in investing in these opportunities. As an example, the Singapore government has pledged up to $500 million to crowd in commercial capital and other sources of finance to support Asia's green transition. And finally, you have your individual investors. They can explore ESG funds, green bonds, or even community investing platforms that align with their values.
Okay, so I'd like to dig a little bit more into ESG. I think that often people confuse ESG with impact investing, but they're obviously not the same. Impact investing proactively drives change, but ESG investing is more of an integrated approach where you integrate ESG factors into conventional investment frameworks to enhance specific outcomes. Could you shed some light on the subtleties between these two different investment approaches?
Yes, sure, Steve. Impact investing is about funding solutions that address a specific social or environmental challenge, but ESG investing, as you rightly noted, looks at integrating ESG considerations into investment decision making. So the focus for ESG investing is on improving risk-adjusted returns, and delivering sustainable outcomes is usually a secondary focus. Another key difference is the measurability aspect and the focus on measurement. In impact investing, being able to quantify and measure and assess the impact generated from these investments is critical and something that investors in impact investing actively look for. On the other hand, for ESG ratings, they are looked at a bit more broadly, and many a times with ESG ratings, you have pretty much inconsistent data at the moment that's yet to be standardized. And so for one aspect of it, you have really precise data, and on the other aspect, while you do have an improvement in the ratings that's coming along for ESG, there is still quite a bit that needs to be worked on when it comes to standardization.
Okay, so that assessment aspect is really interesting. Successful investments are the ones that are backed by a solid strategy and a feedback loop. There's so many strategies, but some are more equal than others in terms of how effective they are in achieving a tangible, sustainable impact. So what do you think here?
Yes, absolutely. One of the most common strategies is to invest in high-impact sectors. This would include clean energy, financials, and healthcare. Here, you're directing capital into sectors that align with long-term sustainability megatrends. This particular approach has seen explosive growth, and as demand for sustainability-driven investment rises, these sectors will likely offer better returns in the long term. Investors can target themes that align with the UN Sustainable Development Goals, or SDGs, such as renewable energy, affordable housing, and microfinance. Another strategy is impact-first investing, where you prioritize social outcomes over immediate profits. In this strategy, your investments are usually directed towards funding early-stage enterprises that address poverty, healthcare, climate, and education. We have, for instance, organizations such as Acumen, which have deployed sizable funds into impact-driven businesses. Here, Steve, I would also emphasize blended finance and how it has been helping scale the impact-first approach. With over 40% of impact investing prioritizing impact over immediate profits, I would say there's an evident shift. And then, of course, we have green, social, and sustainable, or GSS bonds. In 2023, we saw green bond issuance of over $500 billion, and we're seeing a massive growth in GSS bond space over the past few years. And this has transformed impact investing, providing scalable financing for many projects. We also have variants of this, such as social impact bonds or pay-for-success models, where investors earn returns only if predefined social outcomes are met. These have been gaining traction too, and I see this approach continuing to accelerate in the coming years.
Well, thank you, Eugenia. That's really insightful. It's a very interesting topic. And obviously, the investing landscape has been evolving quite quickly and will continue to evolve going forward. And within the impact investing space, investors will probably need to navigate new regulations, shifting market demands, as well as innovative financial structures. It's clear that with impact investing, we can pursue both financial returns and positive sustainability outcomes. With that, we come to the end of today's episode. Eugenia, I'd really like to thank you for joining us, and I'd like to thank our listeners for joining us today. If you'd like to know more about impact investing, please visit the link in the podcast description. I'll speak to you again soon. Until then, please do take care of yourself.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.